So what do we want to mention here? So I want to give a broad introduction to the modeling of risk and the nature of insurance. And if you want to read a bit more about these topics, I refer you to a couple of texts, which I also shared on Canvas, right? So there is a text written by Professor Roger Laven from Amsterdam. I refer you to the introductory section in the lecture notes of Professor Mario Wuttrich from ETH and colleagues, Professor Denuy from Louvain-la-Neuve, etc. So these documents, they are shared on Canvas as some background reading for you. So here we're going to go. So the idea is that we're going to study quantitative building blocks of so-called loss models or risk models in insurance. So these building blocks, they will turn out to be useful in different types of applications. We can study life insurance models or risk models relevant in life insurance. And in a life insurance context, think about a whole life insurance product that will pay your beneficiaries a certain amount of money in case you as a policyholder die within a certain period of time. So in a life insurance context, we're typically interested in modeling the time to death of our policyholder. Yeah? So we're interested there in building a model for a time to event random variable, in this case, time to death of the policyholder. If you look at a non-life insurance product, there we're going to be interested in modeling, on the one hand, the number of events that take place in a certain period of time and the severity or the impact of these events. And if you think about non-life insurance, then you need to think about examples like a motor insurance product or a liability insurance product or a workers' compensation insurance product. And so these are the kind of products or business lines, fire insurance, of course, as well. These are the kind of business lines that I have in mind over here. I did mention the workers' compensation insurance, but I should be a little bit careful with that one. So everything that is related to health insurance, disability insurance, workers' compensation insurance, that's sort of in between the life and the non-life insurance lines of business. So that typically uses modeling techniques which are typical for life, as well as modeling techniques which are typical for non-life products. Here is the health insurance, which I just mentioned. So what we're interested in when we study these kind of products are transitions from an active state to a disabled state, transitions from disabled to recovery to active state again, which we call recovery. So there we are also interested in building models for time to events. And in this case, it's about how much time will you spend in the active state, how much time will you spend in the disabled state, when will you recover from the state, etc. So this is typically handled with tools which are called multi-state models. So that it's a typical tool to work with if you're dealing with health insurance product with health insurance products and with certain disability insurance products. If we switch to the banking domain, which you are studying in the risk management course in more general terms, there the building blocks that we're going to cover in this course will also be relevant if you look at building models for operational risk data, for credit risk modeling. I have a few acronyms over here. So the PD is the probability of default. So that's about modeling the probability of default of a loan, of a mortgage, for example. The loss given default, what will be the loss that the bank incurs given that one defaults on a loan or on a mortgage. and EAD, that's about exposure at default. Yeah. So if you would look at the models that are put into place to study these particular items, risks in banking, then you will see that a lot of the tools that we're going to discuss, that we're going to study in our course, will come back over there, right? We could also label this course as loss modeling analytics or something alike. And so this is what we are interested in. Any questions on this? So what I mentioned here are a few different business lines. I will come back to those later on today. But I think it's good to keep that in mind. So what I will discuss here in the course typically has a focus related to non-life insurance, but one can easily use these tools, these concepts, these risk modeling building blocks, also when thinking about other applications, other lines of business in insurance, or even certain topics in risk models in banking. So before we continue, let's take a moment to talk about risk and insurance. So if you would ask yourself, yeah, what is risk? I've got a few ideas here. I've got a few elements for a definition over here. And I start with the definition in the book by Vaughan and Vaughan, which is in your background reading material on Toledo. So there is risk in a certain situation that implies loosely that in a given situation, there is uncertainty about the outcome. And the possibility exists that this outcome will be unfavorable. So will have a negative impact on the people who are involved in this situation. Now, if you look at the literature written or put together by economists, by statisticians, decision theorists, insurance theorists, etc., they have a big literature on different concepts of risk and uncertainty. And I would say that no uniform definition exists that is applicable to all fields. So the tools that we are going to use are very much focused on the insurance domain. Yeah. So risk is a condition in which there is a possibility of an adverse deviation from a desired outcome that we expect or hope for. So the individual hopes, of course, that this adverse outcome will never occur, but it is the possibility that this hope will not be met, which constitutes the risk. For example, if you own a house, of course, you hope that it will not catch fire, but the risk exists that this house will catch fire. And as an individual, you will seek protection against the financial impacts of this risk, of this existing risk. So I mentioned the idea or the concept of insurance. So we started from a definition of what is risk, and we said, okay, it's the possibility that a certain event can take place with negative financial outcomes on the people who are involved in this event. And as an individual or as a family or as a company, we're going to try to protect ourselves against these potential negative outcomes. And then the insurance device and insurance products become a very interesting tool, interesting instrument to take in mind. So let's start with looking a little bit more into detail into this insurance device. So in its simplest aspect, insurance has two fundamental characteristics. On the one hand, we want to transfer or shift risk from one individual or one family or one company to a group. And the group here are all the policyholders within the insurance company who signed up for the same insurance product. So there is the risk transfer idea. On the other hand, another fundamental characteristic is the idea of sharing losses on some equitable basis by all the members of the group. And we often refer to this idea as risk pooling or risk sharing. So if we look at this risk pooling idea, that means if we look at the portfolio of policyholders who signed up for a certain insurance product, well, all of them will pay the insurance company a certain premium, and that premium can be determined based on characteristics of the policyholder. More on that later on. So all of the individuals pay a certain premium, and by collecting this premium volume, this premium income, the insurance company will be able to cover, to reimburse those policyholders who, for whom that insured event takes place. And the insurance company will collect their losses and will be able to cover their losses with the premium volume and the money earned by investing this premium volume from all the individuals who signed up for this insurance contract. So we share the losses. We share the losses by all the members of the group, because by bringing those people together, the insurance company is capable of absorbing these losses and covering the people from the portfolio for whom the insured event took place. So if we look a bit more into this risk pooling idea, I'm quoting here from the text written by Professor Laven, and he writes, well, this risk pooling idea should be distinguished from risk diversification, because the former, so the risk pooling, is the core of insurance. And what risk pooling does is it adds up and eventually spreads the risks without affecting the total risk of the pool. The total risk of the pool is not diminished or something by pooling risks, by bringing risks together, right? But if you look at risk diversification, which is at the core of optimal portfolio theory in finance, there what we are concerned about is reducing the total risk of the portfolio, right? So these two ideas are different in their ambitions. We have risk pooling on the one hand, where we bring a lot of similar or more or less similar risks together, in a big portfolio. So what that does is it doesn't reduce the total risk of the portfolio, but it is capable of spreading this total risk in the portfolio among a larger group of people, such that all of the people in the portfolio, if they all pay some affordable premium, right, then the insurance company, by pooling the risks, is capable of having enough money, collecting enough money, so that the total risk in the portfolio can be covered, so that the people in the portfolio can be reimbursed for the financial losses that they incur. But if you look at the risk diversification idea in optimal portfolio theory, there the idea is to spread investments so that you're actually reducing the risk in your portfolio of investments, right? So that's a different, it's a different perspective, it's a different ambition, right? So if we continue a little bit more, and then I'll take your questions, and then we're going to take a short break. So if we continue a little bit more in our discussion of what is insurance, and we look at this insurance device from the point of view of an individual, well, from an individual or a company or a household, insurance is an economic device where the individual substitutes a small but certain cost, and we call that the premium that one has to pay. So we substitute a small but certain cost for large uncertain financial loss that would exist if it were not for the insurance. So what we see here is the premium, that's the amount that we pay to the insurance company in order to sign up for the insurance product. We know upfront how much this premium is going to cost us. So it's a small but certain cost. But if we wouldn't sign up for the insurance contract, then we would be facing the risk of getting involved in a uncertain, in an event with an uncertain outcome, with a potentially big financial implication. And think about the example of a fire insurance. You sign up for the fire insurance contract, so you know how much that's going to cost you in terms of paying the premium. But if you wouldn't sign up for the fire insurance contract, you would be facing the risk that your house can catch fire or your belongings can catch fire, and you would be facing the possible big financial implications of this unfavorable event. Yeah? So that's the idea. We trade uncertainty for certainty with the insurance contract. If you look at it from the viewpoint of society, there we can see that insurance is an economic device for reducing and eliminating risk through the process of combining a sufficient number of homogeneous exposures into a group to make the losses predictable for the group as a whole. So what is important here is we try to reduce and eliminate risk by bringing a sufficient number of homogeneous exposures together. So what does that mean? That means by bringing together a group of policyholders, a group of insureds with more or less the same, which are independent and face more or less the same risk. And we're going to handle the losses that this portfolio of risk is facing. Yeah. So a little bit more on that. So why insurance? And here I'm yet looking at one of the alternative sources that I mentioned on Canvas. There is a general demand in our society for protection against unforeseeable random events, which might cause serious financial damage. We've been discussing that. And an insurance product will take care of the financial replacements of that damage. The idea is that the insurance company builds a community to which everybody contributes a certain amount, fixed deterministic premium, and the random financial damages are then financed by this premium volume that has been collected by the portfolio, by the community that we put together. Yeah? So we already discussed this, but that's yet another way of framing it. Right, so we were working with the definition of Professor Mario Wüthrich from ETH in Zurich. And Professor Wüthrich said, okay, what we want to do is, as an insurance company, we want to build a community to which everybody contributes a certain amount, that's the fixed deterministic premium. And this community will then be able to cover the random financial damages that people within the community can possibly incur. Now, what if we look at some of the basic features of such communities? Well, every member should face similar risks, right? An individual member should profit from the diversification benefits in the form of a law of large numbers that applies to the community. And we're going to discuss that a little bit more because you often read the law of large numbers is very fundamental to the insurance industry, let's say. So we're going to discuss a little bit how that should be, how we should be able to understand that. Yeah. Here I would like to put this together with what is sometimes denoted as the motto of Lloyd's of London. Lloyd's of London, an insurance market in London, and you can click on the magenta hyperlink to read more about it. But you could summarize this whole idea as saying, well, what insurance does is it collects the contributions of the many to cover the misfortunes of the few. And I think that it's a very nice and short way of summarizing what we've been discussing so far. So with the contributions of the many, we refer to the fact that all the people within our community, within our portfolio, should contribute a certain premium. The premium is fixed up front, so we know up front how much we should pay. And the premium is affordable, right? So it's a small amount, and it's small at least compared to the potential size of the loss that one is facing in case one would not sign up for the insurance product. So that's what we mean with the contributions of the many, the premiums that are collected. And the insurance company will use the contributions of the many to cover the misfortunes of the few. So the misfortunes, that's of course referring to getting involved in an accident, getting involved in the insured event. And luckily, of course, this only occurs to a very limited number, a very small number of people in our community. These are the few. So when we talk about an event that can be insured, we're typically considering events which have a very low probability of occurring, right? So the insurance contract will specify a certain insurance period. And here we see a big difference between life insurance products and non-life insurance products. So in a life insurance product, you're typically working on a very long-term horizon. You're working until, or you're providing protection against death of a policyholder in the next 20 years or something, or until retirement age. So life insurance products are typically long-term products. If you look at the non-life products, there you're typically working with very short-term products. Typically 1 year, think about a motor insurance product, think about a fire insurance product. That's a short-term, a short period of insurance, typically a 1 year period. Within this specified insurance period, all the insured but random events that occur during this period, which cause a financial damage that is covered under the contract, these financial losses will be covered, will be indemnified by the insurance company. Yeah? And such random payments caused by the insured events, we will refer to them as insurance claims. So you see a couple of terms, some terminology coming up throughout this introductory lecture. We talked about the premium, we talked about the insurance period, we talked about an insurance claim. So these are things we should know after this session. And the insurance premium is, of course, typically paid at the beginning of the period, is paid in advance. Because if you would pay the premium at the end of the contract, then of course you know what's going to happen during the insurance period. Then you know whether you will be getting involved in this insured event or not. So then, of course, in case you're not involved in the insured event, and then people would say, I don't want to pay for the insurance anymore. So that's why we are going to collect the premium at the beginning of the period in advance. Yeah. So here I'm coming to a very important statement for this introductory class. And that is that we say that insurance has an inverted production cycle. And for that reason, loss models and predictive models are essential tools when thinking about insurance pricing, risk management for insurance companies, etc. So what do we mean with this inverted production cycle? And it's typically not so easy, but would you have some ideas regarding this statement? So does anyone want to give it a try to explain what we mean with this inverted production cycle? Perhaps in the chat. Any thoughts? So this is in contrast to a typical OEM, an original equipment manufacturer. An OEM would have a production cycle where you know, more or less, how much the product that you're building, how much it costs you to manufacture, to create this product, before you bring this product to your client. Think about producing an iPhone or something. Then you can make a certain estimate. Okay, this is the costs that I need for buying supplies, for labor, etc. So you can make an estimation of how much producing this single iPhone, how much it costs you, right? And you can use that to set the price for an iPhone in the market. But if you look at the insurance contract, then you cannot say before or at the start of the insurance period, you don't know as an insurance company how much offering this cover to a client, to a policyholder, how much that will cost you. Because you don't know whether this policyholder will be involved in an event, in an insured event with a potential financial loss. You don't know whether the policyholder will be involved in such an event, and you don't know if he or she is involved in such an event. You don't know how much it will cost you as an insurance company to cover the loss of this client. So we say the production cycle is inverted because we need to determine the price of the contract at the start of the insured period, but we don't know how much offering this product will cost us. We only can see how much offering this cover did cost in reality at the end of the insurance period, and even only after several years, because we sometimes have to wait until certain insurance claims are fully settled, are fully developed over time. Yeah? And that explains why when we are pricing an insurance contract, for example, we need to rely on risk models, on loss models, on predictive models, because we need to make an assessment based on historical data, based on certain expert opinions. We need to make an assessment of how likely is it that our policyholder will be involved in a certain insured event. And if the insured event takes place, how much do we expect that this event will cost? Yeah? And so you're going to assess these parts, the frequency and the severity of the insured event. You're going to assess that with predictive models, with risk models. So that's why we have this course, why we're going to talk about these building blocks to design such predictive models, to design such risk models. Does that make sense? So I think this is an important sheet in the sense that I want you to be aware of that. Huh? So insurance has an inverted production cycle. And for that reason, using predictive modeling tools, using risk models is very important in an insurance context, because you don't know upfront what's going to happen and how much it will cost you to reimburse the financial losses. Does that work for everybody?
Yes.
Yes, thank you. All right, so that being said, let's jump a little bit now to this law of large numbers, just to give a little bit of feeling for that. So I'm going to introduce a little bit of notation here, not too much. That will be for the next classes. But let's now start with looking at an insurance company who pulls similar risks with individual insurance claims, denoted here with Y1 up to YN. So we say Y1 up to YN. These are the claims that a certain portfolio of insurance contracts is facing over a certain specified period of time. And what we can then say is, of course, these Ys are random variables. They are random at the start of the insurance period because we don't know which losses we're going to face during the period of insurance. So we need probability theory, we need predictive modeling to say something about these losses. And if we then look at the law of large numbers, and why is that often claimed to be so important in an insurance context? So I'm going to refer here again to the text by Professor Wutrig on the one hand and by Professor Laven on the other hand. So if we look at the text by Professor Laven, we could say, or we can read there, that loosely speaking, the law of large numbers says that upon expanding the number of risks in a pool, the average loss or the average gain in the pool eventually becomes certain or predictable. So this law of large numbers tells us something about the average loss in the pool. Yeah. So if you read this sentence, what I'm now going to try to do is write down this sentence in math notation. So in notation using tools from probability theory. So let's try to do this. So here you see what this statement means in terms of mathematical notation. So if we look at the weak law of large numbers, then we see that for a given probability space, y1 up to yn uncorrelated, identically distributed random variables with a finite mean, what we get is the following statement. And if I bring back my sentence from the previous sheet, what you can now see is that for certain words from this sentence, I use a specific color, and you see this color coming back in my mathematical notation. Yeah, so this is the connection I'd like you to be able to make at this point. So if we look at the law of large numbers, then it says that the probability, here denoted with capital P or PR, probability, the probability that the average loss, and if you look in the green notation, the average loss, that's the sum of the y's divided by the number of losses that I'm facing in this particular setting. And here that's n, right? So the average loss in a pool of risk deviates from the expected loss, and the expected loss is here denoted with mu, because I assume that all my y's follow the same distribution and are independent from each other. So the probability that the average loss deviates from the expected loss by more than a specified amount, no matter how small, and this specified amount is here denoted with epsilon. So the probability that this deviation is larger than epsilon, no matter how small epsilon is, that probability upon expanding the pool of risks becomes zero. So that's what the law of large numbers tells us. So where do you see this idea of expanding the pool of risks? Well, it's not highlighted in a color. I forgot that for some reason, but that's what you see here with letting the n go to infinity. Expanding the pool of risks, then the probability that the average loss deviates from the expected loss by more than a specified amount, no matter how small, that probability goes to zero when the number of risks in the pool becomes large. So that's in words and also in math notation what this law of large numbers tells us. If I go back one sheet, so remember here how we described it. Here we said upon expanding the number of risks in a pool, the average loss in the pool eventually becomes certain because it will go to this expected loss mu, and the deviation between the average loss and the underlying expected loss, that deviation, or the probability that that deviation is larger than a certain epsilon, that goes to zero. So that's what the law of large numbers tells us. So this law in an insurance context is legitimate and useful because it implies that the variability of the average loss in an expanding pool of risks is diminishing, because we know that this average loss will not deviate too much from the expected loss when we're going to increase the number of risks in the pool. But we have to be careful with three fallacies, and that is that the law of large numbers, it tells us something about the average loss and where that goes to, but it doesn't say anything about the aggregate loss, the total loss of the pool of risks. And that is, in the end, what the insurance company has to cover, right? So that's important to keep in mind. Second, This law is not applicable if there is a common component to all the risks, which we often denote as a systematic risk. And third, the law of large numbers is a limiting relation, while in reality, the n cannot go to infinity. So there are certain drawbacks, limitations of this law. So we could ask ourselves, yeah, why is it then so crucial in the insurance literature? So where is this interest in the law of large numbers? Where is it coming from? How is that justified? Despite the fact that we have these drawbacks, which are listed over here. So these are difficult challenges for the insurance industry, because we see that much of the theory that we're building is based upon the assumption that risks can be considered as independent within a portfolio. And if a systematic risk is present, then of course we would have to reinvent certain models and make sure that we can carefully think about ways to perhaps insure or ways to transfer these systematic risks to the financial markets. And the securitization of risk, transferring these risks to the financial market is an example of that. Yeah. Okay, now let's continue on that. So why is then the law of large numbers so important? Yeah. So say that the pool of risks is placed within an insurance company. Then the insurance company will be primarily concerned with the aggregate risk of the pool, because in the end, they have to reimburse all the members in the pool. They have to reimburse their financial losses. So the insurance company is concerned with the aggregate risk in the pool. So why is then the law of large numbers at the core of the economics of risks and insurance? Let's think about that. And here I'm quoting again from the text by Professor Laven. So what we see is that the expanding pool of risks, if n goes to infinity, and the expanding pool of risks gets spread over or subdivided among an expanding number of owners. And the pool becomes bigger, so the total risk gets spread over a bigger group of owners, of policyholders. And it is the average loss of the pool that gets attributed to an individual owner, the variability of which, by virtue of the law of large numbers, is indeed much reduced by risk pooling. Yeah. So what we see, why is it that the law of large numbers is so important in an insurance contract? So the strength is really coming from the increase in the resources, yeah, for absorbing the loss. We increase our resources, we increase the pool of people who can absorb the total loss that the portfolio is facing. So it's not about adding new risks, but it's about subdividing the total risk among more people, which makes this law of large numbers so important and so relevant for the insurance device. Yeah, so keep that in mind. There is a difference between the total risk of the portfolio versus the average loss or the average risk that everybody in the portfolio is facing. This average loss becomes more predictable, which also means that the technical premium and the technical price that we should charge for the insurance cover, that becomes more predictable, because that will really be driven by this expected or average loss. But the total loss in the portfolio is of course increasing if you add additional resources. Yeah.